Welcome back. In this video, we'll talk through examples of assets, liabilities, and stockholders' equity. We'll also talk through what the expanded accounting equation is, and then also how revenues, expenses, and dividends affect the expanded accounting equation. So first, if we recall back from the first video, that assets are resources that a company owns. And examples of these resources can be cash, land, buildings, furniture, vehicles, anything like that that a company has or it owns that it expects to use in the future. An example of a liability will be a note payable or a bank loan. This is where a company has borrowed money from a bank that it has to pay back in the future. So the company is liable for this amount to the bank. Then stockholders' equity can be broken into two pieces. Common stock, which is the amount stockholders have invested in the company. And common stock is the certificates of ownership issued to those investors. And then the other piece is retained earnings, which are profits kept by the company after the dividends have been paid to the owners. And retained earnings are a running total of profits and losses combined since the beginning of time of the company. So to roll over balance each year. And I'll show you more about what I mean in a second. So thinking still on the stockholders' equity portion, in the previous video, we discussed how the accounting equation is equal to assets equals liability plus stockholders' equity. Well, because we can break out stockholders' equity into two more pieces, so common stock and retained earnings, we can also step that basic accounting equation out into the expanded version. So the expanded accounting equation is assets equals liabilities plus common stock plus retained earnings. So we've taken that basic accounting equation and stepped it out one step for the stockholders' equity portion. Now, the retained earnings part of stockholders' equity can be affected by three things during a period. The first is revenues, and revenues increase retained earnings. The next is expenses, and expenses have a decreasing effect on retained earnings. And lastly are dividends, which also have a decreasing effect on retained earnings. So to put this in perspective, let's do an example about XYZ company. This company was formed on January 1st, 2019. During 2019, the company had revenues of $10,000 and expenses of $7,000. In 2020, the company had revenues of $15,000 and expenses of $9,000, and XYZ also paid $2,000 in dividends. And then in 2021, XYZ had revenues of $20,000 and expenses of $14,000 and paid $5,000 in dividends. And the question wants us to figure out the amount of retained earnings on December 31st, 2019, 2020, and 2021. So in order to figure out the ending balance or the December 31st balance of each year, we need to first start with the beginning balance. So I've put up a little table. I have the years across the top that we need to figure out, and then I have the January 1 line where we'll figure out the beginning balance of each year. We'll also write down the changes during the year. So again, we know that retained earnings are affected by revenues, expenses, and dividends. And then that'll get us to our ending balance for the year, our December 31st balance. So on January 1, 2019, this was a big day for the company. This is when the company was formed. We weren't told that the company was formed with any sort of retained earnings, so we have to assume the company was formed with zero in retained earnings because they haven't made any profits or loss. Next, during the year of 2019, the company had revenues of $10,000. We know that revenues have an increasing effect on retained earnings. And then also there was $7,000 of expenses for the company. And I've written the $7,000 as a negative because expenses have a negative effect on retained earnings. And there were $0 of dividends paid, so as such, We take the beginning balance plus the changes during the year. Gets us to $3,000 ending balance for December 31st, 2019 of retained earnings. We started with zero. We added $10,000 of revenues, and we took away $7,000 of expenses. So there's our $3,000. Now, again, retained earnings is a rolling total since the beginning of time. So because of this, whatever you end the first period with, so $3,000 in this case, that'll be the beginning balance of the next period or the second period, so on and so forth. So I ended 2019 with $3,000. That means that I'm starting 2020 with $3,000. And then during 2020, the company had revenues of $15,000. And we said revenues have an increasing effect, so revenues is a positive number. There were $9,000 of expenses. We know that expenses decrease retained earnings, so I'm showing a negative number. Then also in 2020, the company paid dividends. And we know that dividends has a negative effect on retained earnings as well, so you see a negative number. So now, if we take our beginning balance and add to that the changes during the year, we get an ending balance for 2020 of $7,000. So again, we started with $3,000. We added $15,000 of revenues and subtracted $9,000 of expenses and $2,000 of dividends. Now, if we ended 2020 with $7,000, what are we starting 2021 with? $7,000. Right, and then in 2021, we had revenues of $2,000, so a positive number. Expenses of $14,000. Again, expenses have a negative impact on retained earnings. And then lastly, there were dividends paid of $5,000. And dividends also have a negative impact on retained earnings. So we take our beginning balance, add to that the sum of our changes during the year. And so we have $8,000 of retained earnings for 2021.